Converting an S corporation to a single-member LLC is a significant business restructuring decision that involves both legal and tax considerations. This conversion isn't simply a tax election change. It requires dissolving your corporation and creating an entirely new legal entity. When you convert from an S corporation to a single-member LLC, you're changing from a state law corporation to a limited liability company with only one owner. This transformation offers potential benefits, particularly regarding tax treatment, but comes with important considerations you need to understand. One major advantage of converting to a single-member LLC is the possibility of obtaining disregarded entity tax status for federal tax purposes. This status can unlock previously trapped corporate losses, allowing you to offset income. It may also significantly simplify your tax filings as a business owner. However, your employer identification number, or EIN, isn't automatically transferred in this process. The IRS only reassigns a corporation's EIN to the successor LLC in specific situations. This matters because if your predecessor corporation used its EIN for state registrations, licenses, and employment tax returns, obtaining a new EIN could be costly and time-consuming. For example, implementing a new database for payroll services with a different EIN can be expensive. Organizations receiving Medicaid or Medicare reimbursements might face significant delays if their EIN changes. A single-member LLC has several taxation options. It can be treated as a disregarded entity, where business income passes through to your personal tax return. If you add partners, it can be taxed as a partnership. You can also elect to have it taxed as a C corporation or even maintain S corporation status. Speaking of S corporation status, when might a single-member LLC want to elect this tax treatment? The primary benefit is potential savings on self-employment taxes. As an S corporation owner, you can pay yourself a reasonable salary subject to payroll taxes, with remaining profits taken as distributions not subject to self-employment taxes. This option works best for businesses with consistent profits exceeding $40,000 to $50,000 annually. Keep in mind that the IRS requires you to pay yourself a reasonable salary, and if your salary is deemed too low, they may reclassify distributions as wages, leading to penalties. The conversion process varies by state. Some states offer statutory conversion, which simplifies the process, while others might require a merger or asset transfer. The legal structure change means you'll need to address contracts, licenses, bank accounts, and other business relationships. For the actual conversion, you'll need to follow your state's requirements for dissolving a corporation and forming an LLC. If you want to maintain S corporation tax treatment after converting to an LLC, you must file Form 8832 to elect corporate tax treatment, then file Form 2553 to elect S corporation status. In states without conversion statutes, you'll need an alternative approach. This typically involves forming a new single-member LLC, electing corporate tax classification, merging the existing S corporation into the new LLC, and filing appropriate reorganization documentation. Be aware of potential risks in this process. Converting from an S corporation to an LLC means all assets and liabilities are deemed transferred, which could trigger tax consequences, including recognition of built-in gains. S corporations also have rigid ownership rules that may limit future business flexibility. The increased complexity of S corporation status requires more record-keeping, payroll compliance, and legal formalities compared to operating as a disregarded entity. Improper classification of compensation versus distributions can trigger IRS scrutiny. Before making any changes to your business structure, consult with qualified legal and tax professionals who can guide you through the specific requirements in your state and help you avoid costly mistakes. The right approach depends on your unique business circumstances, long-term goals, and the specific laws in your state.